Howdy, everyone. Happy Monday. Welcome to the Statistics Former Students Network webinar. Today's talk will be given by Dr. Jinfei Sheng, Assistant Professor of Finance at the University of California, Irvine Morange School of Business. So Dr. Sheng is an Assistant Professor of Finance at University of California, Irvine. He received his PhD in finance from Sauder School of Business at the University of British Columbia in Canada. He graduated from our famous Texas A&M University with a master's degree in statistics in 2011 under the leadership of Jinfei. His primary research fields are empirical asset pricing and fintech, with a focus on big data, textual analysis, and machine learning. A central theme of his research is to understand the roles of information in financial markets. He's interested in various types of information, including macroeconomic news, earning announcements, news articles, online reviews, crypto white papers, and mutual fund prospectuses. He also examines research topics in labor finance and financial intermediation. His research has been published in leading finance journals, including the Journal of Financial Economics and the Review of Financial Studies. He's also a reviewer for many top finance journals and conferences. As an award-winning teacher, he created a new course on fintech for undergraduate and graduate students and serves as the founding faculty advisor for the Anti-Crypto Association at UCI. Welcome, everyone. Dr. Sheng, take it away.
Thank you very much. Thanks, Elaine, for organizing us, and thank you, Mercy, for being the leader for this alumni network. My name is Jinfei. I was at Texas A&M a long time ago now, more than 10 years ago. I had a lot of great memory in College Station, and I'm glad that I have the opportunity to come back virtually to talk about some new research work that I feel very excited about cryptos. And this is a case about how I use what I've learned actually at Texas A&M a long time ago and applied it in the finance world. So the top topic I want to talk about today is about technology and the crypto valuation, evidence from machine learning. This joint work from Yukun, who is Assistant Professor of Finance at Rochester, and Wang Yi, who is a PhD student at the UCI. So the motivation of this paper is probably some of you already, probably heard from news articles, etc., that excuse me, I apologize for COVID. I got a cold last week. There's a rise of blockchain technology, which has been got a lot of attention from all type of people, for example, news media, expert in policymakers, etc. And many people believe that blockchain technology is very revolutionary, has been revolutionized many aspects of our life, like innovations, etc. And one of the earliest application of blockchain technology is that is about using it for cryptos. Just want to give you a brief, whether you kind of familiar with crypto or not. Cryptocurrency is a digital currency stored transferred through blockchain. One example is Bitcoin. You can use Bitcoin for transfer monies or store values. As of this year, there's already over 10,000 cryptos with market cap over about $2 trillion. This market is already very big and become actually very important asset class. Some of the retirement company, for example, largest one, Fidelity, just announced a few weeks ago that the investors can actually invest up to 20% of their retirement account to crypto market. But there's actually, well, despite this motivation, there's a lot of debates about cryptos as well, or blockchain technologies. There's kind of two narratives going on now. One narrative is that people believe the blockchain technology, which behind the crypto, is so revolutionary. It's the new internet, new electricity, and excuse me. So there's a lot of positive sentiment about the technologies. But however, on the other hand, there's also growing concern about and criticism about cryptos, and because of speculation, scams, and bubbles. right? And for example, in the recent few days, the cryptos since last week has been dropped dramatically. So the volatility of this crypto market is very high. So all these reasons actually get a lot of people's attention and a lot of negative comments about. So this paper is trying to understand that kind of essential of the debate is that, so the debate essentially is about the blockchain technology is so good, right? People believe that, but the blockchain technology applied in cryptos, the application of blockchain technology in cryptos is very bad. Like kind of that's a narrative. So how could we recognize these two kind of debates? One way to think about is that actually we didn't really have empirical or academic evidence is that how should we understand the role of technology in crypto space? So that's why we want to kind of, one of the central questions in this debate is that whether technology matters for crypto valuations, right? If the technology is so important, so good for cryptos, then we would see that the technology should have positive impact for the crypto valuations. That is exactly the research question for this paper. We try to examine the way the technology of cryptos affect their valuations. Now, this is very, very important question. It's one of the central questions in this space. You may wonder why nobody hasn't studied it yet. The answer is that it's very difficult. The difficulty comes from the limit of data. Measuring technology is very challenging because limited information variables, especially for cryptos. Cryptos, there's not much information except the price. We do observe the price of cryptos at a very high frequency, but besides that, there's not much information. It's not like stocks. You've got quarterly earning announcement, quarterly financial statement, etc. For cryptos, is the other information available is very limited besides the price. So what we do in this paper, we focus on self-disclosed white papers, which is when the cryptos they want to issue at the beginning. Think about, if one company want to go into public, they need to provide some information. Now for cryptos, it's not required by any regular bodies that you have to provide white papers, but most of the cryptos, about 80% of cryptos, they do provide white papers. What they do is that in the white paper, they will outline what they're gonna do, what technology they use, what's their goal, etc. They want to try to attract fundings, developers. They want to carefully describe all the aspects of the initial coin offerings. Therefore, in this case, we want to kind of focus on this so-called initial coin offerings, which is when the coin launched and then will provide the coin to the public. Now, even with a white paper, that is one of the most important information for the coins. That's the reason why we choose white paper. However, the white paper is text data, right? It's descriptive. It's just a bunch of documents. Excuse me. Now, with that data, how could we analyze in a numerical way, right? How can we use statistical tools to analyze that? That's also very challenging. That explains why, even given the importance of topic and give some data is already very variable, why people haven't done that. Excuse me. So what we do in the contribution of this paper, we use several machine learning methods to construct so-called tech index. We use supervised machine learning. We use unsupervised machine learning, such as LDA, word embedding. Essentially, what we do is that we use statistical tools and programming algorithm to read through over 1,600 white papers. We use machine to read through all these documents, try to find some information, and we convert this textual data into numerical data before we perform the statistical analysis. Just want to give you quick preview about the results in case I couldn't finish all the presentation and given the time limit. What we found is that for the cryptos that with high tech index, they're more likely to succeed in terms of raising fundings and get listed on crypto exchange. They're less likely to be delisted from the exchange, and they're better performed in long run. And overall, the conclusion is that overall we do find that the technological sophistication is important a driving force for crypto valuations. So despite there's debates about a lot of criticism about scams, about cryptos, but we do find that if the cryptos that they do employ advanced blockchain technologies, their long-term performance tend to be better. Excuse me. Now, I will just be very brief about the literature contributions. Briefly speaking, in general, this literature in finance has been mainly focused on theory part. There's a lot of theories talking about how important the technology is in the models, but there's very limited empirical evidence. So we believe that is one of the first empirical evidence to directly test the importance of technology in crypto space. On the empirical side, there's also several papers that study what affects the crypto valuations, but none of them focus on the white paper, the texture of the white papers. And in general, this paper also fits the finance literature that try to use texture data. But the previous literature has been mainly focused on use news articles, online reviews, etc. This paper's contribution is we use the machine learning to study the cryptos. We believe that our paper is making important contribution to the finance literature. Now, let me tell you a little bit about how we measure, right, about the technology sophistication, the tech index. What do? We start from about 3,000 initial coin offerings. We collect a bunch of information. We essentially write a Python program to weather scraping a lot of data. And we also get the return data. And the most important part is we try to get the ICO white papers, which is actually a very time-consuming process. We spend about 6 months to collect all these data. We create a tech index, and what we do is with the text data, we create a tech index. We also measure the readability, terms, and uncertainty about these documents. We construct the tech index by several ways. We use both supervised machine learning and unsupervised machine learning. The supervised machine learning method is that what we do is we manually read through randomly select 200 white papers, and we assign scores. Of course, we ask people who have the technical background to read that, and we train the model based on these 200 white papers score. The unsupervised machine learning method is that we use word embedding, and we also use LDA. Now, there's definitely, for some audience who are familiar with this, supervised, unsupervised machine learning. So the advantage of supervised machine learning is that it mimics, how we think about this. But it depends on, how good these people, the investors, right, the people who read the white paper. So the advantage of unsupervised machine learning is that it does not require any human input, right, and expert knowledge. It does not really have a strong prior about what we should learn about these documents. So in the end, what we do is a tech index essentially is a fraction of words that belong to the tech topics. And what we also do is that we have like 3 tech index from these 3 methods. We also create a composite index that is a simple average of the 3 index. So in many of the analysis, the result is pretty robust. It doesn't matter which tech index we use, but for simplicity and for comprehensiveness, we use a composite index for most of analysis. Now, this is how we identify topics. For the LDA method or word embedding, what we do is that we find the optimal number of topics using a mathematical method. For both methods, we found that the optimal number for the data is about 20 topics. And the second step, what we want to do is we want to find the topics that is related to blockchain technologies. Here is an example of how we find these topics. So essentially, in this LDA method, we found that about 3 topics that is related, which is information, blockchain, and systems. These topics are for these 3 topics, we calculate a fraction of the documentation that belong to these 3 topics, and that fraction is the tech index. The first we want to understand is that to understand the tech index, we study determinants of tech index, and we look at various of crypto characteristics. We look at whether they use Ethereum blockchains, which is a very popular blockchain platform. And we also look at the GitHub data. We look at the white paper information and a bunch of other characteristics. We found that Ethereum-based coins, they are actually the tech index is lower, which is intuitive. So Ethereum blockchain is relatively basic compared to many advanced other blockchain technologies. So that's why it's not surprising that the ones that do not use Ethereum blockchain, their tech index actually is higher. We look at a bunch of variables from GitHub website. We found they're also consistent with the intuitions. For example, the number of commits is positively related to the tech index, which means that the ones that have high tech index, they also get more commits, which is essentially more support from the tech community on the GitHub website. We also look at a bunch of other variables, but there I was just interested and skip them. Now, the more important part of the results is about the tech index and crypto performance. Now, before I move on, I would like to ask audience if you have any questions. I'll be happy to stop a little bit and yeah, if you have any questions. All right, I will just continue. So the key empirical part, empirical analysis in this paper we want to do is that we want to analyze the several outcomes of ICOs, okay, of regressions. What we do is the first set of variable, we look at the crypto ICO success, essentially whether when you launch coins, whether you get money or not, or whether you get listed or not. We use in this case we measure it by whether it's listed on crypto exchanges. So this is very simple OLS, and we've got the main independent variable we are interested in tech index. In the main dependent variable, sorry, main independent variable is success. Okay. What we found is that the coefficient on tech index is positive and significant for both measures. This means that the coins that have high tech index, they're more likely to succeed, more likely to get fundings. This is also consistent with our hypothesis, means that tech index actually, technology sophistication actually matters for the crypto valuations. Of course, this is only the very short-term performance, right? We also want to look at longer sample period. We look at 7 days, 30 days, and 90 days. Surprisingly, we found that the coins that have high tech index, they do not their performance actually does not actually is not better than the other coins, and the coefficient on tech composite in this case is not significant. It's positive. However, if we look longer sample period, such as 180 days, 240 days, and 300 days, then the coefficient become positive and significant. So what's the main takeaway then? The main takeaway here is that the tech index actually have positive impact in long run, but the impact on the short-term performance is not significant. So this result actually suggests that it is a behavior explanation. So the investors, they do not really recognize which coin is better than the other ones in short run, and it takes time for them to finally figure out which one is better than the other ones. So it take eventually they value the good ones with higher returns. Okay? So eventually investors actually recognize the better ones. We also look at another variable is so-called ICO delisting, which is outcome variable that if the coin is performed really bad, then they will be get delisted. So this is essentially a negative outcomes for the coins. So the hypothesis here is that if the coin is really good, they are less likely to get delisted. And we found indeed the empirical evidence is consistent. The coefficient is negative and significant. So meaning that the coins with high tech index are less likely to get delisted subsequently. Okay? And the economic magnitude is actually quite big. A 1 standard deviation increase in tech index leads to about 2.5% decrease in delisting probabilities. This is pretty high numbers. So we also look at various of other evidence. Any questions from our audience before I talk about additional evidence? We also look at about readabilities. I will just show one evidence. So what we do is that we look at whether the document is easy to read or not. We have interaction terms. Okay? We found the interaction term is negative. So essentially, the long horizon interpretability is weaker for cryptocurrencies with high readability, easy to read, which makes sense, right? If the document is easy to read, let's say the tech index, which means that the effect is weaker. We also look at this, about whether there are long-term reversal or not. We essentially do not actually find evidence. We look at this main result over longer sample period. We look at 300 days, 330 days, and 360 days. We found that if we look at long horizons, the coefficient on these the coefficients are not significant. What does this mean? This means that there's no long-term reversals. Okay. There are no long-term reversals mean that it's not overreaction at the beginning. Okay. So essentially, if there's overreaction at the beginning, then we would expect that there will be a long-term reversal in the end. Right? Think about this way. So if people are overreacted to the good cryptos, then eventually they will realize that this is not good enough. So then there will be reverse in the returns. However, we found that this is not the case. We also have a lot of robustness tests, and for example, we use other measures of ICO success. We use instead of using the regular LOS, we use Logit regression model. We also have new measures of return that deal with delisted coins. Now let me show you one of the evidence. So here we use trading as a measure of success. We found similar evidence. The coefficient is positive and significant. We also look at Logit regressions. In this case, because of the dependent variable is a dummy variable, right? So Logit regression make more sense here. But we found similar evidence, so the result is very robust. We also look at different other tech measures. For example, essentially we look at two measures. One measure is from the commit from the GitHub website, and we also look at simple word count from the documents, from white paper documents. What we found is that the tech index, the result with tech index is very robust, and the result is still there. And if you look at the last column, which includes all the measures, we found that the tech index actually have the stronger result in terms of its impact on the ICO success. So the main takeaway from this picture, this table is that the tech index indeed it matters, and even after controlling, even compared to other tech measures. Okay, now to conclude, what we do in this paper is we construct a set of 4 text-based index, technology index from a comprehensive sample of ICU white papers. And we show that technology sophistication is important driving force for crypto valuations. And we found that the cryptos that with high tech index, they're more likely to succeed. They're less likely to get delisted. And although tech index does not significantly affect the short-term returns, but it has positive impact on the long-term performance. Our findings actually have very important policy implications, because right now, these coins are not required to provide any white papers. We believe that we show that there's important information from white papers, and it probably makes sense for the policymakers to require the coin, all these companies to provide white paper if they want to issue coins. And for investors, and I think the important message is that there's valuable information from the white paper, and investors should probably read the white paper carefully before they invest in these coins. And given that the coins are extremely volatile. Okay. Any questions from the audience? I didn't expect the presentation goes through so this fast.
Sorry, I have some questions.
Yes.
And I've been wondering, because the stochastic differential equation SDE is widely used in financial mathematics and quantitative mathematics. I wonder if the SDE has also already been applied to modeling the cryptocurrency, or will it be a good fit modeling tool to model the cryptocurrency?
I think there's some there's a lot of research on crypto already. So SDE, I think it can be a good way to study that. But I think before you apply the method, you want to make sure the characteristics of the cryptos that will be fit the SDE, right? You want to make sure that what's the advantage of SDE and why crypto is good settings. I think can be interesting applications.
Okay, thank you. And another question is, I wonder, what is the euro size of the data set for the cryptocurrency data analysis?
Well, I have one of the slides here. So the data slides. Let me look at this. Here we go. So in general, there's a lot of cryptos nowadays. So when our sample period focused on from 2017 and 2018, we had about 3,000. We started with about 4,000 or 3,000 coins, cryptos. I would say the regular size is usually you want to collect as many as possible. It's quite normal that you have several thousands. If you have less than 1,000, probably that's a little bit too small. But I think as long as you have more than 1,000, that should be good enough. What happened is a lot of the coins are very small and very illiquid. They got delisted anyway. So although when you go to the website, for example, some coin market cap, if you go there, there's more than probably 10,000 or even 20,000 coins. But the majority of the coins, like 90% of the coins, they're not really traded in the market. It's not very liquid. So for academic research, probably not that helpful if they're not liquid. So the bottom line is that if you have several thousand of the cryptos, that could be a good sample to start with.
Okay, thank you. Can you please comment on what kind of time series models do you use to modeling this kind of time series data of the daily price and trading volume, this kind of?
We don't really, in this case, we do not really study the time series patterns try to understand. What we do is try to understand, we already identify some independent variables, right? And we already have some independent variable. We try to understand the in this case is a regular OLS, right? So we are trying to understand what's going on with this. Of course, with the return variables, is already stationary variables. We make sure that there's no it's a stationary in the sense that it's log return, right? So it's log data. And if there's some a lot of outliers, then we will initialize the outliers. That is quite a standard excuse me, procedures in the finance and economic literatures. Yeah.
Okay, thank you.
Yeah, but if you are interested in to understand the time series patterns, in general, these cryptos are very volatile. So you probably can find some seasonality, etc. If there's anything you want to understand. Yeah.
Yeah, that's true. Thank you.
Any questions from the audience? Yeah, let me talk one small thing, and before I probably can let you go. So one thing I didn't really introduce at the beginning, probably I should talk about is the initial coin offering. So what is the initial coin offering, and why it is important in this setting? So initial coin offering is one new fundraising tools for startups. Essentially, what happened is that a lot of startups they issue tokens or coins in exchange of capital from investors, and tokens can be listed on crypto exchanges for public tradings, which is similar to the IPOs. So that is kind of how this works. So the coin will be first do initial coin offerings to the investors. Then they will be listed on exchanges, and then there will be information about their price that we can track down the price, and that how we study their performance in short run and long and in long run. Okay. All right. If there's no further questions, that's I think is for today's presentation. I think I finished a little bit early, but I guess that's fine. I believe always that if you can finish the presentation early, that's a good thing.
Thank you very much, Dr. Sheng. A very interesting talk. Yes, last call for questions today. Or any other comments, perhaps? Very cutting edge technology, right?
Yeah, indeed. Yeah, it's very it's relatively new. So that's why I think the statistics background is really helpful for me to kind of carry out this type of analysis. Yeah.
It's very nice to see different applications. I think it's good for students and also colleagues and co-workers to see.
Yeah, I mean, of course, this method can be also applied to other I would say not finance. It's not limited in finance. Can be the textual analysis can be applied to any of these. For example, probably biology, pharmaceutical. If you want to analyze any documents, right? Paperwork.
Right.
Instead of reading by people, you can read it by machine to understand what's going on, the topics, right, etc. Yeah.
Save a lot of time. All right. Anyone else? Any other questions or comment? There's just one comment, I think, in the chat at this point. There are a couple people actually thanking you for your talk.
Yeah, if you have any questions, the paper is public online. You can download from SFSN. If you have any questions about this paper or this methodology or the application of stat tools in finance in general, feel free to reach me. So my information is online. It's very easy to be found.
Wonderful. Thank you, Dr. Sheng.
Thank you, everyone. I hope that I have opportunity to connect with you in other occasions.
Thank you.
Thank you very much, everyone. Bye-bye.
Thank you for attending, everyone. Have a great day.